Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, we are trying to help you have a better financial retirement. We created this show and this channel just for that purpose. We do this by answering your questions, so you can feel free to send in questions now. We'll try to answer them live. I can send them two different ways: the email, asktom@talkmoneywithtom.com, or the chat itself. We also cover questions that came up in our strategy sessions this week, so feel free to send them in anytime during the week, for that matter. We'd love to try to answer any questions you can throw at us. The main areas we cover are asset management, retirement planning, and tax planning. We think those are the three biggies within this arena to try to help people have a better retirement. We have those subjects on our channel now. Over 1,000 videos here. Great resource, we think, for you to kind of start your education. The more you know, we feel like the better your financial retirement will be. So you can subscribe to our channel if you'd like. Also, there's a little bell that you can hit if you want to get notified whenever we post new content on there. And of course, you can meet with us on a one-on-one basis. Just with Eason and I, you go to our website. There's a link there on the channel, and up in the corner you'll see a button that looks just like that. It says book appointment. You can hit that and set up a 30-minute video or phone call with Eason and I, and we can kind of go through your specific issues that you might have in more detail. So great that you could join us today. I hope that you're able to grab onto something here, take that back, and be able to use it to try to improve your retirement. Retirement is a great portion of life, whether you're already in it or not. It's still something to really be able to maximize as much as possible. So going to start off the show with a conversation about what I saw happening in the stock market. This is part of the educational component about asset management and kind of what to do, talking about how we manage the assets too. So I'll share my screen here so we can see this. Here's the S&P 500. Way back at the beginning there is the top, right? Mm-hmm. So 4th of January last year, all-time high, S&P 500. Markets coming down, we can see that red line. It kept coming up and hitting that and hitting it over and over again. The blue line that's just above my head here is actually a 50% retracement line. So it just shows from the bottom of the pandemic, 2020, to the top last year, we've kind of came all the way back and gave back half of that gain just for one day. You can see that little spike there. That was October 13th. And so since October 13th, we've been moving upwards. Now, it's not a straight line, right? We're kind of still above where we are. We finally broke through the red trend line there, set up a new high. Unfortunately, we're starting to have some difficulties here, and we'll talk about why. But you can see at least intraday here, we've kind of come back through that red line. Now, that's not wildly unusual, actually. If it gets below it a lot or stays below it for a certain number of days, then we start to worry about it a bit more. But having it kind of drop through there are some things that are moving the market to the downside. We'll talk about those that are somewhat concerning. And so we've made some changes to the portfolio today. We have kind of a green light, red light, yellow light system. We were in the green light based on the bounce off of the 200-day moving average last week. We made those changes. And then we went straight from that to a red light today. So red light means that for our retirement accounts on the stock market side, we have moved those pieces into T-bill. Normally, we don't see these many moves happening. We don't get this defensive. But we're in this situation where we're still technically in an overall downward market. And so you have to be really careful that we don't end up with sort of kind of the floor falling out from below us. We were kind of bouncing around in 2008 and sort of hanging in there, and then all of a sudden we had a 30% drop. So that's what you have to be aware of. I'd rather be in T-bills right at this point, heading into some of the things that are going to be happening over the next couple of weeks, but we'll see what happens. So let's talk about kind of what happened this week. And here's a chart of the 5 minutes, every 5 minutes for the day. And so you can see we've been basically going down all week, right? But more so kind of there at the end here, the second half. So that's yesterday and today. You can see that red line there is actually the trend line. So you can see when we broke through that today. Now, a lot of different things happened that were kind of catalysts to this because the market was doing very well at the end of last week, really well, actually. And But on Tuesday, Chairman Powell met with the Senate Banking Committee, testified there, and had some very aggressive things to say, seemed to leave the door open for the half a point rate increase. He had always been the one that was kind of more reasonable, didn't seem like it on Tuesday. And so the market, you can see that big little drop there at the beginning of the week. That was Tuesday during his testimony. And really never recovered from that, because what he said was that, hey, we're seeing, especially in January, a pretty hot economy. We need to bring that down. Job market is very tight. Lots of jobs created. Retail sales were high, et cetera, et cetera. And so we need to bring that down. He also testified in front of the House on Wednesday. Actually, if you look at Wednesday there in the middle, not as much motion.
Pretty much flat.
Yeah, it really was. And then he was done. The market was relieved. We saw this kind of jump up that we see there. Unfortunately, and that was Thursday, yesterday, one of the regional banks had trouble, had liquidity issues, losses on bonds and those types of things. And the market sold off pretty hard for the second half of yesterday. And you can see that right above my head here. And the reason that is a concern is just simply because of really what happens in terms of 2008. There was one thing after another started to kind of fall, and then eventually we ended up with this big downturn. And so it's bringing back those fears. Even though the banking system's quite healthy, it still makes you worry about what's going on.
Yeah, and you can see the drop was it spread to other regional banks. Even though they may not have these similar issues because they're separate businesses, they still got hit by having this fear.
Yeah, overall, there's a fear in this type of situation within the big market participants that when you raise interest rates this much, you risk having something break. Okay, so Lehman Brothers was the last straw that kind of broke that market, but we had Bear Stearns back in 2008, quite a few things that were breaking. So is this, isolated in terms of, this situation, or are there other kind of scenarios out there that are happening that people would be worried about? Kind of like that rot underneath, the floorboards that you can't really see until it, but it's there. And so that's what people are worried about, is the direction, going, in this nice recovery where the pent-up demand is going to push things forward, or are we kind of, going the opposite direction? And just to switch back, I'll give you kind of an analogy here that's kind of interesting. If you go back to May, all the way through now, we've basically been going sideways with a big range, 4,300 on the top and 3,500 on the bottom. That's a big range, but we've been in that range since May. I mean, we're getting close to a year of being in that range. This is very similar to what happened the last time inflation was fairly high. And so, we're right in the middle of that range right now. So you got to be a little bit careful of overreacting to what's going on. However, if you just sit there right now, you've basically made nothing, and there's some potential to make some money within that range, in my opinion, because it's a big enough range. And so I think this is a different type of trading methodology here. And the reason we're in that range is because the analogy I would have is like a teeter-totter, and you got a group of kids that are waiting in line to get on this teeter-totter. And, right now, the two kids that are on that teeter-totter are relatively balanced. They're the same size, maybe the same age or whatever. And one kid on that side believes, hey, things are getting better. The pent-up demand is going to push, retail sales, and people are going to spend money, and that's going to help the economy. The job market is picking up. Lots of new jobs, 500,000 jobs, that came through, and then another 311,000 jobs this week. So that's that one group, and they're the ones that are buying, and they're buying these dips, and they're coming through. And they're also buying, if you look at the run-ups, they're buying like things that might do well in the future.
Yeah.
Yeah, so they're okay. They'll say, hey, I'm going to hold on to this for 5 years, and, in 5 years this could be worth a lot of money, and I want to buy it now because it's cheap or cheaper. Then there's the other side, the other kid that's on that teeter-totter who is essentially, worried about what's going to happen with inflation and what the Federal Reserve's going to do. Because the Federal Reserve has to raise rates to bring inflation down, but there's a big lag for when that hits the economy. So they really have a very difficult job. If I raise rates as the Federal Reserve a half a point or quarter point, in a couple of weeks here, I'm not going to see the impact of that for 3 to 18 months, depending on who you talk to and depending on what it is. And so that's why it's so easy to overraise rates because they constantly do this actually historically. So they see these data points and they see, okay, job reports and whatever it is they're looking at, and they raise rates, and all of a sudden something breaks and then you get this other scenario. And that's the other kid on that teeter-totter.
Yep.
And so as the kids change out, we get these up and downs. Sometimes the kid who's optimistic is bigger and he's kind of driving things up, et cetera. So, what we're worried about here altogether is just kind of really breaking out of that range. So that's what we'll watch for. And many of the articles out there are talking about establishing a new low for this year, right? That's all over the place. And again, once a lot of people start saying something, it's even less likely to happen, but not impossible.
Yeah, and with this regional bank knowledge, or kind of run, you
Right.
could say, it kind of most of us glossed over the jobs report that came out, and
Yeah.
the jobs report came out a little bit higher, but it was kind of a mixed bag overall.
Yeah, it was 311,000 jobs, supposed to be 225,000 jobs.
Yep.
The article I read today said that they've exceeded expectations on the jobs report that comes out once a month here, 11 months in a row. So I'm thinking the expectations are a little bit low for what's been happening here, but still, it's kind of interesting because it's still less than last month. Last month was readjusted back down to 504,000, so that's actually a good thing.
Yep.
Unemployment actually went up, right? Again, ironically, in this environment, unemployment going up is a good thing because a softer job market has the potential to lower inflation faster than a tight job market. So that was a good thing. And then the other big thing that's, again, a good thing as far as the stock market is concerned in this environment is that the pace of growth of wages was better than expected. Yeah, it's still, wages are still going up. They're just not going up as fast. And so, that's been coming down. So theoretically, when you look at what happened in the jobs report, I think it's the same as last month because the same thing happened. Lots of jobs, wage growth was less. So it's 2 months in a row that we've had that. That's a perfect scenario. We need lots of people out there to get into these service businesses because that's where the tight inflation is, and the supply is short in the service businesses, mainly because we don't have enough people working there.
Yeah,
Right.
and having like a slowing down of wages shows that the market is kind of loosening a bit.
Yeah.
There's been also a decline in postings too.
Right.
And also in the last 2 months, there's been an unusual spike in government hiring. So
Yeah.
they've hired 164,000 jobs in the
Yeah.
last 2 months. And it's unlikely that that will continue for the foreseeable future.
Yeah, could be a beginning of the year bump. Something that's happening there as far as that goes. Yeah, so it's kind of interesting if you look at the bond market, and I'll show you that here. Here's the 2-year Treasury yield. Notice that it came down predominantly on this report today from the jobs.
Yeah.
So if the yield comes down, that means the bond is going up. Okay, the bond market liked that report. Now, the stock market didn't like that report. The bond market liked it. Now, in my opinion, the bond market is kind of leading the way here as far as understanding what's happening with the numbers as they apply to inflation, because that's kind of what the bond market looks at the most. And so I think that's very fascinating. We'll see what happens if that yield, because that went from over 5% down to 4.6. That's actually a fairly big drop. And so, we'll see how that plays out. It could be that there's just a run into treasuries, right? And so lots of money's going to treasury when it got to 5. So it could just be a pure supply and demand and not so much a reaction to that report that came out, today, and or even the report about the bank that had trouble. So that's something to watch, though. We'll see that. But it's very fascinating to see the bond market do this well and have yields come down this much in this short of a period of time. So very interesting week, really interesting time frame. The market is moving very aggressively. We've been moving fairly aggressively to kind of match that. We're not moving yet our taxable accounts. We've had those in place. We have a much slower signal that we use. We have a whole basket of signals that feed into this kind of process for us. And we'll make quicker moves inside of retirement accounts, Roth IRAs and IRAs and those types of things, because there's no taxes. And we make much slower moves on the taxable side because there can be taxes, or even just putting it on your tax return and dealing with it. So But we're very close to triggering those also on the taxable side right now. We'll see how this plays out, but if we continue down a bit more here next week, we'll be making some changes there too. So yeah, very interesting time frame. So good. Thank you for joining us this week. Look forward to being able to talk to you again next week about the summary. So let's start off with the questions. What do we have here today?
I think this question has been on everyone's mind. Is Silicon Valley Bank a Contagia event?
Yeah, so this is a regional bank that had trouble yesterday, needed capital infusion due to some bond market losses and what have you, and a couple of different things. But nonetheless, that's the big issue, right? How much does this impact what's happening with other banks? Mm-hmm. So we did see, I think, First Republic, for example, got hammered this morning and then recovered. Yeah. I mean, I think you were telling me, Ethan, you could have doubled your money today if you timed it perfectly.
Yeah, it opened at like $69, dropped all the way down to 45, and then it peaked out at 95, and now it's around 80 something. So it's a volatile day.
No kidding. And so, yeah, this is just harkens back to everybody's memory about what happened in 2008. Mm-hmm. It was a banking crisis. I would say, as a whole, from what we've seen from the numbers, especially the big banks, because that was the big deal. Silicon Valley Bank is an important bank. It's not a big bank. It's not too big to fail. It's not, none of those. In 2008, we're talking too big to fail banks for struggling, yep. And that's why we end up with a 30% drop. And Lehman Brothers, everybody knows who Lehman Brothers is. Not everybody knows that much about Silicon Valley Bank, So I'm not surprised it's a technology kind of centered bank, because that has been where things have had the biggest adjustment, right? Because in 2020, when we were all stuck at home, everybody was doing things with technology companies essentially, and they were doing fantastic. And then everybody shifted their money focus to, other things. Businesses shifted away from buying PCs to put in everybody's homes to not having to do that. Consumers went from, buying stuff on Amazon and goods to going out to restaurants and what have you. So you're seeing like Peloton, that's a great example of a kind of, it's not a tech company directly, sort of. I'm sure they consider themselves somewhat technology oriented, but nonetheless, it's just the thought process of where the shift of money is coming. And so we've seen some of the bigger layoffs have come in the tech companies, around here locally. And so that's what's concerning people, is just what's happening. At this point in time, it's one bank, right? And really, my thought process in these environments especially is that you watch the price of the market. You look at the S&P 500, for example, and we tend to look at the Vanguard Total Stock Market Index. That's the one we look at the most, just because it has more stocks in it. I think it's a better representation of the overall market, but either one will get you pretty close. And, if there's going to be continued problems in areas, generally speaking, you'll see that reflected in the stock market first. Because you and I might not know what's happening. We didn't know about Silicon Valley Bank, but we see the motion happening. And if you see the stock market continuing to come down, all of a sudden you might hear about something else that's going on. And so that's why they say that the information essentially is in the price. Not all information, but enough for you to maybe, parse out what might be happening. So I think it is an important component, but I'm not too worried about it at this point per se. The market is down a few percent here. This isn't Lehman Brothers at this point. I think it's just a matter of continuing to watch to see what happens going forward. Is this an event that creates problems for other banks? Yes or no? Does this create, are there other situations out there that we're not aware of? I always use this saying, but, Alan Greenspan had this comment I always thought was very funny. When the tide goes out, you can see who's swimming naked, right? So when business starts to tighten up, and when recessions start to come into play, and when inflation comes in and is raising your prices, and when the Federal Reserve is raising rates at nearly record rates, the tide is going out.
Yep.
And so then you're going to see, here's this bank that didn't quite have it all together, obviously, and are there others? Who else is out there? And so that's kind of what's happening right here. It is one of the things we watch for. We've all been talking about China, for example. Are they going to have a property problem and those types of things? So, we'll see what happens. Things are definitely tighter than they were, and that's partly the object they need to tighten things up to be able to get inflation back down.
Yeah, and you can see like a lot of the banks that are regional banks that are having issues are ones with more exposure to technology, usually venture capital, or they have some sort of crypto. Like Silvergate
Yeah.
earlier in the week was in the news cycle, and so you're seeing more cracks in the foundation, you could say.
Is Silvergate strictly a crypto bank, or are they just have crypto exposure?
I think there's heavily crypto exposure.
Yeah.
I think they began with crypto in mind when they started.
Yeah,
out.
because we've definitely seen contagious within the crypto arena. There's no
Yeah.
doubt, and that's because of the way that they structured those. One of these crypto banks is depositing their own currency that they made up in the other crypto bank, who then is leveraging that maybe or giving them back another currency. It's all interrelated with these tokens that often are just kind of made up. And so, yeah, that's a little bit different than what we're seeing here with this regional bank, but it's still money.
Yeah.
I mean, the money disappeared. There was I've forgotten the number. What, 3 trillion in crypto, down to 800 billion now, or something like that.
Yeah.
That's money that would have been in the economy potentially, or had the potential to come out and stimulate things.
Yeah, and you can think about how the scale of Silicon Valley Bank is 200 billion,
Yeah,
which is a much smaller scale.
yeah.
And so I think the last time a depositor lost money with a bank or going out of business was 1980. So the FDIC will step in and protect a lot of these people.
Yeah, yeah, and there's probably enough capital out there to bail that situation out. I mean, that was the problem with Lehman Brothers. They were so big and they needed so much, because they were actually asking, as I remember, for 150 billion in a rescue package. So that's almost the same size as Silicon Valley Bank.
Yes,
just to patch the hole.
I think Silicon Valley has 200 plus billion, and they only have 187 billion in deposits. So they still have enough assets if they were to liquidate essentially everything.
Yeah, yeah, exactly. So I would suppose, I mean, we saw this at the beginning of the cracking in 2008. They were bailing things out, so Bear Stearns cracked before Lehman Brothers. Bear Stearns got the bailout. The Lehman Brothers did not. They probably should have bailed out Lehman Brothers as long as they were going, because once the Lehman Brothers fell, it became a huge issue.
Yeah.
And the government ended up putting out way more money in TARP and all these other, save the planet programs that kind of got the whole run that we had just recently going for about 12 years. So, yeah, nonetheless, it is definitely something to watch for. And in the end, watch the overall market and see how it's going to respond and what's going on. A lot of times the market will peak out and, start to come down, and it doesn't make sense that it's coming down, and then eventually you'll hear why.
Yeah.
So watching that price is critical. It's what we do on, a minute-by-minute basis, basically. Good. That's a great question. What's the next question?
How does Roth conversion affect my Medicare premiums?
Roth conversion. So Roth conversion is taking money that you have in a 401k, IRA type of asset, 403b, 457. All of these are retirement plans that are what's called tax deferred. So it just means that you put money in, you didn't have to pay any taxes on that money when it went in, and you only have to pay taxes when you take it out, right?
Yep.
So 401k, you save for, maybe you get a match. And so you have the capability of pulling money out of those tax deferred accounts and moving it over to a Roth IRA where it will grow tax free for the rest of your life. And so there's some big advantages in the sense that, obviously tax free is better than tax deferred. If I make 15% tax deferred, I pull that money out, I'm going to have to pay taxes on that growth. I make 15% tax free, I pull that money out, I don't have to pay any tax. Very, very powerful. There also is a required minimum distribution, from your tax deferred accounts, which means that, when you get old enough, 73, 75 eventually, you have to start pulling money out of those accounts. And so that can be a real onerous scenario in retirement, believe me, especially if you have a fair amount in those accounts. If you do the math and look at it, you'll be surprised at how difficult that's going to be for a lot of people. So you can convert, but when you convert, it's taxable.
Yep.
So if I take 50,000 out, or 100,000, or 200,000, whatever it is, That ends up on my tax return, let's say in 2023. Well, if you're over 65, you are enrolled in, most likely, I think almost everybody is enrolled in Medicare. And so inside of Medicare, they have this tiered system. Depending on how much, I think 167 is the lowest right now for Part B, and then it goes up, and I think it gets nearly $600 a month.
Yeah, it can get pretty expensive.
Yeah, and so it depends on how much you make. And so let's say, and again, it depends whether you're single or joint also as a filer. Let's say that that bumps you up into a higher Medicare bracket, which it would potentially if you exceeded that bracket. And Medicare is kind of different. In normal taxes, if I go, $10 over the bracket from 24% to 32%, I'm only paying 32% on that $10.
Yep.
Yeah, so that's not bad. It doesn't really matter. If I go $10 over on the brackets inside of Medicare, I'm in the next bracket, period. Yep. I just went from 167 to $300 or whatever it is, right? And so it's just even a dollar. I mean, $1 over. So it's a kind of a planning nightmare we have to deal with. But because it's very difficult sometimes when you're doing these conversions to figure out how to fit inside of those Medicare brackets, because there might be some other surprising income that comes through that bumps you up. So you usually leave a margin. But that is part of the calculation. You either try to stay inside the Medicare bracket, or you basically make sure that if you're going to pay the extra Medicare, that it still works out.
Yep.
The tax-free growth outdoes it, even though you paid the taxes. Now, it's a weird, explain how the taxes work, because it's kind of unusual. So if you get a 2023 increase from your Roth conversion, when does that affect your Medicare?
So if you're doing a conversion, let's say this year, so 2023, you won't see that there's a lag period till you see that premium jump. So you'll only see the premium jump for your 2025 premium.
Yep.
So it's like because you file in 2024, they have to evaluate your income for 2023, and then they send you a new letter for your 2025 premium. So that's why there's that lag period. So it's essentially, you don't see it for 2 years, that jump.
Does it stay up permanently, or what happens?
It doesn't. It's based off of that income each year. So your 2024 return would affect your 2026 premium.
Got it.
So it's just a 2-year lag period.
So if you're continuing to do Roth conversions to try to get rid of your tax-deferred accounts or reduce them, you could continuously see yourself, every 2 years after that, having a higher Medicare. So why would you do this? What's the advantage of doing this now? Let's say, I'm 66 and I'm converting Roth. Besides the tax-free growth, what am I saving long-term in Medicare?
So the idea is, once you become, if you convert everything to Roth, let's just say that, then any income, any money you withdraw from your Roth retirement account is not taxable, and so you won't have any taxable income. And so when you look, the IRS for Medicare, when they look at this, there's no taxable income, so they can't raise your premiums.
Yeah, so what we've seen, and we've got a whole bunch of cases here within the practice where people are permanently paying more in Medicare, and some of them are paying the max in Medicare for the rest of their lives because of how much money that they have in tax-deferred accounts. Now, this is a first world problem, right?
Yep.
I mean, this is a good problem to have, but it's still very painful, and I get a lot of consternation from clients about it, and I understand that. Because they're stuck. There's no way to change it. I'm 78 years old. I'm forced to take money out of my retirement accounts through what's called the required minimum distribution. We call it the RMD. And every time I take that out, I'm in the upper bracket on Medicare. And I'm stuck there for the rest of my life. And so what we're doing is we're going back to the people that are, younger and talking about, hey, this is the scenario that you might be facing when you're 78, right? And beyond. And the way around that is to have some pain now and do some conversions. And even if it does mean some increased Medicare, then the rest of your life could be better because the Roth can grow tax-free. There's no requirement to take anything out. And even if you do, it doesn't affect your Medicare.
Yeah.
And that's pretty nice, actually. Hard to do. Very hard pill to swallow. But we have had some clients that have gone all the way through the process and done the full conversion. I think they're going to be really happy long term.
Yeah, it's tough to pay taxes, especially
It,
those big tax bills.
it is exactly right. It's a better inheritance too, right? I
Hmm.
mean, so it's a really nice situation. So if somebody inherits your IRA, they have to take it out over a 10-year period, right? It depends on who's inheriting. Let's just say it's your kids.
Yeah.
And so if your kids are inheriting your Roth IRA, they also have to take it out over a 10-year period, but it's tax free. So they could leave it in there, let it grow tax free for 10 years, which would be my high recommendation.
Yep.
And and then take it out, and there's no consequence. And versus you leave them $1 million to $5 million in retirement plans, first world problem, good thing, they're probably pretty happy. However, they have to take that all out over that 10-year period, and they're probably not going to want to take it all out at the end because it would be really extremely expensive from a tax standpoint. So they're going to want to take some out maybe every year. They're going to have taxes every year for 10 years that might be at an elevated rate. And they're going to, oftentimes they're in their peak earning years,
Yep.
at that point too. So it's going to be kind of expensive for them. And so it really depends. And so it's one way to kind of give to your children is to kind of, get these things moved over to tax free if it makes sense. You got to do the calculation. We use a really great program to analyze how it works and whether your net worth will increase or not, what bracket you could move in, fill up, looking at the Medicare, how much of that should you fill up? Should you go over the bracket anyway because it makes more sense long term? All of these questions come up in this planning process. And if you're ever going to meet with us for something, boy, I would say that's one of the most powerful things we're able to do for people. Obviously, we try to make as much money as we can in the stock market, but we're at the whims of the market. When you look at tax law, you can really do a lot of things. I focus on tax law a lot because I think it's a more certain return.
Yeah. If you play the tax law just correctly, you're guaranteeing you're paying less tax, and there's nothing that really can be changed about that.
We've seen some monstrous numbers for Roth conversions for comparison of what net worth would be in the future.
Yeah.
So here I am, I'm 65, what would my net worth be at 85 or something along those lines if I went down the path of just keeping my tax deferred accounts versus doing the conversion, and what's my net worth differential after tax in both of those situations. And so you just increased your estate dramatically because part of your estate is tax. So if I have a Roth, I don't have any tax on it. I got rid of that part. And so anyway, it's a unbelievable area. We talk about it on the show all the time. It's one of the best tax planning pieces. And again, it's something worth talking to us about. We have a lot of expertise here. We can really help people. All right, what's our next question?
What changes with my taxes if I sold a house last year?
All right, so 2022, I sold my home. And what's going to happen with my taxes?
Yeah, essentially, I guess what's the changes for this tax year filing, or sorry, 2022 filing, I guess, which is this year.
2022 filing that I'm filing right now?
Yeah.
Okay, well, first of all, you potentially have a gain.
Hopefully you have a gain.
Yeah, not everybody does, right? I mean, that's a funny thing with real estate around the country. Not everybody makes money, but we have a hard time seeing that here in the Silicon Valley. Although the bank here might be struggling, boy, the real estate hasn't for a long time. And so what happens is that, you paid something for that house, and that's going to be included as part of your cost basis. It gets a little bit complicated there if you've been rolling up into different homes. You have to go back to an older home for cost basis. We'll leave that out of the picture. So let's say you're selling a house for $1 million, and you paid $100,000 for it. It's probably a condo anyway. So I don't have to pay taxes on that $100,000.
Yeah, you
That's
get
nice.
return of capital is always tax
Yeah,
free.
that's right, because they don't double tax you on that. Now, I then did some improvements, and those improvements have to be in a certain category. We won't get into that detail either, but I get to add that. So let's say I had $100,000 worth of improvements. I now have $200,000 I can get back because those improvements came out of my pocket. I already paid taxes on that
Yep.
money in my pocket. So, okay, I get that back. And then the government does give you a break. They give you $250,000 each. So
Yep.
$500 for a couple, $250,000 for a single. That just gets no tax. So now I had $100,000 purchase, $100,000 improvements. let's say it's a couple, 500,000. So I have $700,000 I don't pay taxes on.
Yeah, and this house has to be your primary residence.
Yes.
And it has to be, I think, 2 of the last 5 years
Yeah,
is considered your primary residence
exactly.
to qualify for this.
This doesn't apply to rental properties, a totally different deal. So with the primary residence, so I now have a $300,000 gain. So that's what's going to happen, to my tax return that I'm filing this year for 2022. I'm going to have a $300,000 gain. Now, the nice thing about capital gains, it's a separate tax system.
Yep.
So they include all of your incomes together, and they take a look at that and say, okay, you're in this capital gains bracket. 15%, 20%, whatever it might be. It is less than the ordinary income bracket.
Yep.
And they then take the capital gains money kind of out of the overall pool, look at the rest, it gets taxed at ordinary income. It is ordinary income, taxable asset. As far as that goes, there's a few weird things that fit in there, but
Yeah, and then also one thing to consider is, are you going to be hit with the net investment income tax?
Yeah.
So sometimes, depending on where you fall in the brackets and how much income you have and net income or investment income, you get a 3.8% surcharge on top of that.
Yeah, that's the Obamacare tax or whatever, the ACA tax or what have you too, that comes through on these gains. And now that can also, and the last question dealt with Medicare and how things can affect Medicare. And so that would affect your Medicare. So 2022, you would have had this income, and in 2024, 2 years later, you might have a higher Medicare payment for a year.
Yep.
Right? In that case, unless you're selling a house every year, it might only be one time, kind of temporary. And that's just part of the deal. So you made $300,000. Part of it goes to the government in income tax and capital gains tax. Part of it goes to the government as a payment, higher payment for Medicare, right? Still pretty good deal. You got to live there. It's not. Of course, you had to fix it up. Houses are in a constant state of decay. That's always fun. But and whether you actually made money is depends. But nonetheless, that's how it works. That's how it would impact your tax return. It's something we deal with all the time too. If you're going to sell your house, or if you are in the process of selling your house, we have a lot of expertise in that area also, and how the taxes work, and then more importantly, how to make this work from a cash flow standpoint, how it impacts your overall financial plan. And it's because you got to go somewhere. Theoretically, you're moving somewhere. What does that cost? How does that work out? What are the taxes where you're going if you're doing to a different state? Those kind of things. Lots of things to consider financially. All right, we have time for one more.
Why is the bond market going up so much today?
Yeah, so the bond market is really going up a lot today. Ironically, the stock market, at least when we started the show here, was going down, and both responding to the same thing, which is predominantly this employment report that came out. And personally, when I look at their employment report, yes, there were a lot of jobs created, 311,000. The expectation was 225,000. So part of me says, okay, that's a problem because the job market's still tight, it's still hot. The Federal Reserve's going to want to raise rates even more because of that. Maybe they're going to over-raise rates, which they've done so many times in the past, and something's going to break, the market's going to fall, those type of things. At the same time, we're in this weird scenario. We're in a pandemic still, or we're getting out of it, but part of the pandemic, we're still short people coming back to work from the pandemic for lots of reasons. Early retirement, fear of the virus. Some people, probably didn't need the money because
Some people just retired.
Yeah, exactly. I have a lot of clients where one person stayed home to take care of the kids because they were doing Zooms, and now they're just and they permanently have set up the new financial situation, and sometimes they even move to a cheaper area to make that work. So, those are situations. So the more people that are coming back to work, though, the better it is for the service industry, which is where the bottleneck is right now. Everybody's shifted over to spending money on services. Healthcare, we're all going back to the doctors now. They're running around like chickens with their head cut off, but their cash flow is probably a lot better, right? You're looking at restaurants, hotels, travel, airplane, all that kind of stuff. Those mainly need people to come back into those positions. And so the more jobs created, the more we can release the, constraint on services. which should help inflation. And we also saw another positive thing in there where the rate of wage growth is slowing down, and it has been slowing down for a couple of months. Still going up, but going up at a slower rate.
Yeah, it was 0.2, and the
0.2.
expectation was 0.3.
Yeah.
And if you analyze that 0.2 to the year, it's 2.4%, and that really falls in that sweet spot for the Fed.
That's right. Exactly right. That's exactly what they want to see. So he's talking about month-over-month growth in wages, and the expectation was 0.3. So it's nice to come in. So I think personally, when I look at what's happening with that jobs report, I think the stock market should find that pretty appealing also. I do think there's this other piece that's happening with this regional banks that might be overlaying and maybe even more concerning to the market than what's happening with this jobs report. But I think the jobs report was positive. However, I also thought the last job report was positive with 517,000 jobs. And that was kind of the peak of the market, right?
Yep.
Because, again, and I don't disagree with this. The main methodology that people are using to describe why that's a problem is because the Federal Reserve might look at that and overraise rates. And that has been an issue for the Federal Reserve. You go back to 2000, 19 rate increases. They overraised rates. They were responding to, a situation of, massive growth from 95 to 2000, where the government was pumping out money getting ready for Y2K. Then we had another one, 21 rate increases for the 2008 downturn, right? And so, again, that's a situation where the government was responding to a crazy hot real estate market. I mean, you fog a mirror, you could get $1 million piece of property, at least temporarily, until it all fell apart. But so, that's the concerns, that are happening here as far as that goes. So, it's good stuff.
Yeah, next week will be interesting. We have CPI coming out, and market is probably going to make big moves on that, whatever number comes in. Yeah,
it really could. The expectation, looking at nowcast, within the Cleveland Fed, they do a thing. The overall CPI is supposed to come in around 6.2. It was 6.4% last month. So still down. Core was actually up last month and beat expectations, so that was a problem. So we'll see what happens this month. Core tends to be more of a driver here for the Federal Reserve, especially because they're looking more at services, which are more part of core inflation number, which core doesn't include food or energy, for example. But let's just say it comes out at 7% or something crazy, right? I mean, the market's going to drop, or if it comes out at 5.5%, I mean, these are extreme, but the market. So in November, we had a 5% jump because the CPI number on November 10th, CPI number came out much lower than expected. So that's a big event, definitely. And then the week after that, the Federal Reserve meets and will come out and tell us whether they're doing a quarter point or half a point. The expectation right now is leaning towards a half a point. So again, if they do a half a point, probably not that much happens. Maybe the market drops some. More probably important to see what they put in their statement of economic projection, which they're going to do for this meeting. How many, what they call the dot plot. It's basically a plot of showing where people on the governor's board think interest rates are going to be in the future. And sometimes they use that to kind of scare us too. It works pretty well. So
yeah, we're heading into a Fed blackout period, so we're not going to actually hear anything from the Fed till their next meeting. Last
blackout period, the market went up a lot. The Fed has been doing so many negative interviews. Just having them stop for a while, market kind of floated up. So I do think there's some things here with this banking situation and other things that might offset that, quiet period. But yeah, that's a good point. Very, very interesting time frame right now to be watching and seeing how this plays out. Things could work out fantastic or not. We're in a defensive position, and we'll stay there until things get a little better, but we're ready either way. All right. Well, thank you very much for joining us today. Really enjoyed this. Again, you can send in the questions during the week. That's great because we get a chance to take a look at them and do a little research if we need to. Give you a good, response. Secondly, of course, you can, subscribe to our channel and go ahead and push the subscribe button. Push the bell if you want to get notified when we put new content. We believe education is the key here to having a more successful retirement. And of course, lastly, If you'd like to meet with us, please do. You can go to our website, which there's a link on our channel here. Go to the book appointment and set up a 30-minute time to meet with Ethan and I on phone or video, and we'll get the ball rolling and see if we can help you. All right. Well, thank you very much for joining us today. Really looking forward to being able to see you again next week. Thank you.